Hello friends, today is my 26th presentation and the subject is 51 causes that can adversely impact the financial reporting of the key finance related to finance and accounts function in the P&L account. This is overall my 57th presentation considering all the YouTube presentation that I have made so far. What is included in this presentation are number one, an overview of the 51 heads of finance expenses in the P&L account. Number two is first head one, which is called interest on borrowings. Second head is payment of taxes. Third head is foreign currency transactions. Fourth head is share issue expenses. Head 5 is fixed deposit related interests. Head 6 is depreciation, and head 7 is discontinued operations. Now let me share the overview of all this. In the first row, you'll find that the first broad head is interest on borrowings, which has got 8 subheads under the borrowing, which I will take up in the subsequent slide. And there are 7 causes related to these subheads which can adversely affect the P&L reporting. Number 2 is payment of taxes. It has got 7 subheads, like income tax and GST and so on and so forth. And there are 8 causes identified which can affect the P&L reporting. Foreign currency transactions, loss related to that. There are 10 subheads which are captured in this presentation, and there are 6 causes which can adversely affect the P&L reporting. Likewise, share issue expenses, 8 subheads and 7 causes. Fixed deposit interest, 3 subheads and 6 causes. Depreciation, 7 subheads, 9 causes. Discontinued operations, 8 subheads, and 8 is the number of causes that can adversely affect the P&L reporting. And total overall, there are 51 heads of finance, which incidentally happen to have 51 causes which have been identified. Number 1 is head 1, which is interest on borrowings. Now, list of 8 subheads included in this are interest on capitalized expenditure, also called capitalized costs. Such interest costs become part of the asset's value and are depreciated over a period of time or the useful life. Number 2 is interest expenses, also called expensed cost. These are like borrowings, cost of borrowing funds, bank loans, etc. Third is interest on overdraft and lines of credit. Fourth is fees for early payment of debt obligations, penalties paid. Interest payment of the debt that could potentially be converted into equity, for example, interest on convertible bonds. Any cost, any cost related to the issuing the debts, like fees paid to bankers, discount on the bond issued below the face value, interest payment on leases. So such interest costs are recognized as expenses in the period incurred, reducing the company's profit on the P&L account. So that means under the one broad head of interest and borrowing, there are 8 subheads. Now, causes that can affect accuracy of the financial reporting of the interest on borrowings in the P&L account. There are 7 causes identified. Number 1 is misclassification. That there is unethically classifying borrowing cost for qualifying assets as expenses instead of capitalizing them to inflate the current period profits. Number 2 is capitalization of the policy manipulation, intentionally settling on an appropriately high capitalization rate, overstating the assets value on the balance sheet. This further inflates the profits due to increased depreciation. Long-term borrowing for operational expenses, using these long-term borrowing funds for operating expenses. Lack of transparency, that means insufficient disclosure in the financial statement, notes or full debt terms, etc. not reported. Intentional omission of the some of the borrowing costs. Falsifying interest expenses, unethically overstating or understating the expenses to manipulate profits, and omitting few of the interest expenses. Number 2 head is payment of taxes. It has got 7 subheads like current income tax expenses, deferred taxes related to the income tax, payroll taxes, TDS matters for that, GST, goods and service tax, imports duty related custom duties paid on the imported raw materials or equipment or finished goods, property tax, fines or penalties paid on such delayed filing, etc. or other reasons. The finance and account team can include these taxes in some other appropriate expense heads but must not duplicate this. So these 7 heads have been shown just for clarity. 8 causes that affect the accuracy of the financial reporting or payment of taxes in the P&L Act. Understating the tax liabilities, deliberately understating tax liabilities to reduce the reported expense and show higher profits. Early or late recognition, unethically recognizing the income tax expenses too early or late in the accounting period to manipulate reported earnings. Applying incorrect tax rates, improper accounting for deferred taxes. Aggressive tax accounting, this means that taking overly aggressive positions on tax reductions or credits to minimize the reported current income tax expenses. Manipulating taxes, aggressively taking tax reductions though not meeting eligibility criteria. Omitting a few tax transactions and incomplete tax disclosures, that means downplaying the potential tax liabilities, pending tax audits, tax disputes, tax minimization schemes, etc., not reported in the disclosures. Type 3 major head is foreign currency transactions loss due to that loss in that. There are 10 subheads in that. One is the realized losses, say on the imports, wherein paying more in the home currency due to weakening exchange rate compared to the when the import transactions was initiated. So this needs to be captured as part of the foreign currency transaction loss. Realized losses, foreign currency loans payable, exactly similar to that. Realized losses exports, receiving less in the home currency due to the strengthening of the foreign currency compared to when an export sale was made. Foreign currency adjustments, denominated investments like losses due to adverse foreign currency fluctuations on the investments. Interest on foreign currency debts, interest expenses on foreign currency bonds or loans. Interest on foreign currency finance lease. Unrealized losses, this is important and sometime included. This reflects the potential loss on the outstanding foreign currency dominated monetary assets like receivables or liabilities like payables due to adverse exchange rates movements at the reporting date. However, the treatment of these unrealized losses needs to be done in consultation with the strategy company auditor. Hedging costs, losses due to the ineffectiveness of the foreign currency hedge which are taken. Transaction fees related to the foreign currency, bank fees of foreign currency conversions. Impairment charges on the foreign investments, charges related to the impairment of the foreign investment due to adverse foreign currency movements. These need to be added together to know the total cost of this loss on the foreign currency transactions. 6 causes that affect accuracy of the financial reporting: falsifying the foreign currency fluctuations, intentionally overstating exchange losses, impact on the interest expenses to manipulate the reported profits or losses, or omitting few foreign currency transactions altogether. Misrepresentation of the exchange loss, intentionally overstating the exchange losses to manipulate financial results. Number 3 is inappropriate timing of the recognition, delaying the recognition of the losses to inflate current period profits. Number 4 is improper disclosure related to the losses attributed to foreign currency receivables or foreign currency vendor payables, foreign currency loans payable, foreign currency equity impairment charges, currency risk hedging instruments like derivatives. 5 is unethical currency speculation, engaging in insider trading or market manipulation to profit from the foreign exchange fluctuations, leading to unfair advantage and potential legal charges. Non-compliance with the accounting standards, non-compliance with the standards related to the treatment of the losses or gains, resulting in the inaccurate financial reporting and potential regulatory issues. Type 4 share issue expenses. There are 8 subheads identified under this. One is the financial advisory fees for undertaking share issuance, underwriting fees or commissions paid to the investment bankers or underwriters, legal and professional fees, printing and administration cost, fees and transfer agency fees for registering new shareholders and maintaining shareholder records, marketing and promotion expenses such as road shows and advertising cost and investor presentation, brokerage and placement fees, includes brokerage and commission on shares sold, regulatory expenses. Point number 8, cost incurred to regulatory bodies for filing share issuance documents and compliance costs. Now there are two options for reporting these. One is that immediately reporting these share expenses as incurred in the year. Number 2 is amortizing the share issues over a period of 2 to 5 years. This needs to be discussed between the management and the auditor. 7 causes that affect the accuracy of financial reporting. Classification error, incorrectly classifying the share issue expenses as operating expenses, or vice versa, oversetting the expenses, capitalizing and amortization abuse, choosing to amortize the issuance expenses when inappropriate and not meeting accounting standards. Hidden costs, companies can potentially hide significant costs from the investors by failing to disclose all the share issuance expenses, manipulating timing for recognition of the expenses, delaying the recognition of the costs associated with the share issuance to artificially boost the current period earnings, off balance sheet financing, structuring certain share issuance activities as off balance sheet transactions to avoid immediate recognition of expenses, lack of transparency, insufficient disclosure vis-a-vis accounting treatment chosen for share issuance expenses and is rational, and fees or compensation structure for advisors, underwriters, etc. Not reporting properly. FD related interest. There are broadly three subheads: interest expenses on the FD, penalties for premature withdrawal, that is also an expense, TDS on the interest, recording TDS as an expense related to the fixed deposit in interest income. 6 causes that affect the accuracy of the financial reporting of the interest expenses on the FD in the period. Misstatement of the interest expenses, that is oversetting or understating the interest expenses. Misclassification, incorrectly classifying FD scheme interest as another expense category on the P&L. Improper accrual accounting, delaying or omitting the recognition of the accrued expenses, interest expenses, leading to inaccurate financial reporting. Hidden interest, not disclosing all the effective liabilities or the assets associated interest expenses. Intentional default, defaulting on the fixed deposits to avoid recognizing the interest expenses, and manipulating the TDS to minimize the tax liabilities. Type 6, depreciation. Head does depreciation. It has got broadly 7 subheads like depreciation on the building, depreciation on the plant and machinery, depreciation on the office equipment, which includes depreciation on the fixtures, computers, printers, etc., etc. Depreciation of the vehicles, impairment of the fixed assets, right? That is the write downs on the assets due to changes in the market conditions, technological advancements. Then sixth is amortization of the intangible assets such as patents, copyrights, etc., and cost of disposal of these assets, uh, which includes cost of dismantling, removing, or selling assets at the end of the useful life. Depreciation is primarily a non-cash expense that reflects the allocation of the assets cost of the accounting periods over its estimated useful life. Depreciation can be of two types primarily. One is straight line method of depreciation. Number two is accelerated depreciation method, which is in the initial period the depreciation rate is higher. Depreciation expenses are therefore determined based on the assets costs, salvage values, depreciation rates, and useful lives. 9 causes identified which can affect the accuracy of the financial reporting of depreciation in the P&L account. One is the unrealistic estimate of the useful life, useful long extended assets lives. Number two is unrealistic estimate of the useful short assets life, which is vice versa of the earlier one, which reduces profitability in the current period. Overestimating the salvage value, underestimating the salvage value, change in the depreciation estimates, making frequent changes, unnecessary changes to depreciation estimates, classifying minor repair expenses as capitalization, classifying major repair expenses as expenses, this can which can understate depreciation in the current period, non-disclosure of the impairment loss due to or disposal loss, concealing that, and inappropriate and inconsistent depreciation methods used. Type 7, operational discontinued expenses. Now, operating expenses, these are ongoing expenses associated with the discontinued operations until its final disposal or sale, closure, etc., such as salaries and wages of the employees still working in the discontinued operations, rent or utilities for facilities used by the discontinued operations, depreciation and amortization of the assets related to the discontinued operations, cost of directly selling inventory related to the discontinued operations. So, second head is assets write down cost. If the fair value of the assets associated with the discontinued operation falls below their book value, the loss because of that, difference because of that. Asset disposal cost, inventory write down cost for the unsold inventory if the sales realization is lower than the book value. Consultation fees, advisory services for discontinued operations, operating losses of discontinued business, environmental remedial costs associated with the decommissioning facilities or addressing environmental liabilities. One-time closure costs such as severance costs payable to the employees, lease termination fees, uh, assessed disposal costs, and contract which need to be prematurely closed, termination cost for that. Now, important thing to remember here is that the discontinued operations sections must also report any related income from the discontinued operations, such as revenue generated during the period before disposal. The net result, loss or gain from discontinued operation, is then included in the overall net income figure of the P&L. 8 causes that affect the accuracy of the financial reporting for vis-a-vis the discontinued operations. One is a misclassification of the expenses, intentionally misallocating general operating expenses as cost or discontinued operations to artificially inflate the reported losses or impairments to make the discontinued operations appear worse than it truly is. Failure to disclose hidden liabilities, under understating the assets write-off amount, understating the inventory write-off amount, improper allocation of the variance costs, incomplete or unclear disclosures, delaying or discontinued operations business segment, delaying this existence of the discontinued operation to an appropriate opportune time, or even concealing it, and assets and inventory disposal, improper disposing of the assets or inventories at the below market price in collusion with the buyers or for the personal benefits. So these are the 51 uh, heads which I have identified and 51 causes. Now these are covered primarily in my book, second book, in various chapters related to these various type of costs which are there. Uh, Now you can refer to my this thing availability on the Amazon for both India operations and for international markets. You can also refer to some of the blogs which are there on the website related to the corporate finance and accounts function, and at my website which is listed here. You can also refer to some of the articles of interest which might interest you on the Facebook and LinkedIn. Thank you very much.